Good morning, everybody. This is Patrick MontesDeOca with Live Trading Talk for May 14th, 2022. This is a special weekend update for gold. As we end the week with a pretty volatile period for the gold market, we have seen basically the market come down from the recent high that was made on April 18th of 2003 to a low that we made as of Friday's close of 1797. What I wanted to do on this segment is to examine the Fibonacci retracements since the low that was made of 1704 on August 6, 2021, in combination with the standard deviation principles, you might say, and see where the market is in relation to those two metrics that we use. If we take a look at the low that we made back in August of 21 of 1704, we're using that as the measurement low to connect to the high of 2082 that was made on March 8th, 2022. This was a phenomenal move in a relatively short period of time. And not until January of this year, of 2022, did we begin to see the market reverting from the extreme below the mean or the standard deviation of 1923. The first thing I want to do is examine the Fibonacci retracements and see where the market has pretty much retraced since the high was made of 2082 using those two metrics. We see that after the high was made of 2082 and the low of 1704 was made, we established a trading range that essentially is indicating the price has come down to almost a 78.6% retracement, which is normal within the confines of a bull market, of a longer-term bull market, which we have established in the gold market since 2020. In fact, 2019 was the beginning of the bull market after the Federal Reserve actually increased the first time, 25 points. Putting the fundamentals aside, what I wanted to see for my own trading is where the market is in relation to standard deviation and the Fibonacci retracements. And what we see here basically is that the 78.6% retracement is at about 1784.90. The low that was made so far was 1797, and that's pretty close. And right below that number, we begin to see the extreme below standard deviation levels that are indicating that the market has reached a very strong level of support. It has completed almost a 78.6% retracement, Fibonacci retracement, and the price is at the buy one level of 1844 and buy to level of 1792 using 2 standard deviation. So the combination and synergy of these 2 indicators, which are strictly technical, mathematical in its nature, is indicating that the probabilities are very high when you get into this range, particularly in blue. Standard deviation probabilities are running at about 90-95% probability that if the price rejects these levels here and closes either above the buy 1 level of 1844 or comes down to test that 1792, even 84 below the market, and reverts, then we're looking at a 90-95% probability that the mean reversion principle will take us back to 1923 when the signal is activated. So I wanted to do this report prior to the market confirming this signal that is going to be very specific. And I'm doing this segment in order to show you how prospectively precise the variable changing price momentum indicator can be in giving us self-directed traders the opportunity to see mathematically where the market is, not fundamentally. That is another aspect of the market that actually is contrarian to what the price is saying. It was important for me to do this video for my subscribers, for my traders, because potentially what we could see here, if we close above 1844, is a pretty strong signal that would identify a monthly trigger point activating the targets of 1923. My opinion is that the prices have come down to test where the strong buying exists. And when you take a look at the Fibonacci retracement of 78.6%, and you take a look at the probability model, the standard deviation is confirming that this level potentially is where we're going to see some buyers come in, some strong buying taking place. And that's what this indicator identifies for us, is where is the completion of the extreme above the mean or below the mean. In this case, what you see here, when we made the high of 2082 on March 8, it went into a very strong area of resistance, or red lines, you might say, that identifies the algorithm as the area where you can expect supply to come into the market. It's called distribution of supply. And this is the standard deviation extreme above the mean, where if we do get the supply as expected that came in here, as you see in this this big red bar, after making a big green bar, it confirms the reversion to the mean is about to take place, as you see here, and reverting back up to that high, or that level in red, you might say, reconfirmed reconfirmed the downtrend was to be unfolding. And if we break below the average, then it identified the extreme below the mean. And in this case, the levels that we are at currently. Strategy. If you are long, don't despair. If we get the confirmation on a close above 1844 or a test of 1792 or 84 next week, and we get a reversion from there, that would be a great signal to add to your current long positions. It's a great time to dollar average. It's a great opportunity to enter at an excellent value, because what we're seeing potentially here is the seasonal loss, the spring seasonal loss. Let me focus on the cyclical period, the next 360-day cyclical period that began for us on September 29. The cycles begin September 29. The 360-day cycle ends on September of 2022. And what we see here is that the first cycle basically took us up from the 1731 level, and it made the low as expected. And we published in the Associated Press, we published in Seeking Alpha. It took us all the way out to around November 16. But we made the annual low on November the 3rd at 1764. The market after 1872, in that vicinity, 79, corrected back down to a low of 1757 on December 15, which actually was the official annual low of 2022. From this low, you can see we're moving into the target that was expected in the report that we published in Seeking Alpha on September 28 of 2003. And so we completed that 360-day cycle, and it was expected once the market reaches that price target that it will test the levels below. The reversion to the mean principle will unfold and will bring the prices down to the levels where it would identify again strong buying. So anybody that bought up here on the basis of the war, on the basis of the geopolitical crisis between Russia and Ukraine, obviously is underwater or got stopped out. And that's pretty much the function of the market, and that's the function of stops, which is why we suggest our traders do not use straight stops. Only when the position begins to enter a profitable level that you trail the position at that point with a stop, such as on these trends that are unfolding. Coming back here to the gold market, my strategy again is to continue to buy into this area as I expect the market to break above 1844 and complete the pattern and the target of 1923, which is the monthly average or the mean. If we close above 1923, then we're reactivating the sell 1 level of 1976 and the sell 2 level of 2056.
Good morning, everybody. This is Patrick MontesDeOca with Live Trading Talk. Testing one. Testing 1, 2. We have a couple of issues here, and I would like to restart, come back again. I apologize for the inconvenience.